Hey, from all bookkeeping and taxes, and today we're diving into cash flow statements. Cash flow is the heartbeat of every business. Even startups backed by big investments rely on it for survival. Wondering how to measure cash flow? The answer lies in creating a cash flow statement. In this video, we'll walk you through everything you need to know about cash flow. We'll share tips on managing it better, explain how to create a cash flow statement, and show you how to use it to make smarter financial decisions. What is cash flow? Cash flow measures the movement of money into and out of your business, essentially tracking where it comes from and where it goes. Positive cash flow occurs when more cash is coming into your business than going out, allowing you to cover bills and expenses. Negative cash flow means you're spending more than you're earning, which can lead to financial trouble. Why does cash flow matter? If your cash flow isn't in good shape, your business could face serious challenges, even if you're earning more than you're spending overall. How does that happen? Let's look at an example. Say you own a small web design agency with 3 employees, each earning $2,500 every 2 weeks. You've just landed a huge contract that will double your revenue for the year. However, you'll run out of cash in 4 months, and your first payment from this big client isn't due for another 6 months. This creates a 2-month gap where you can't pay your employees, leading to potential business closure unless you secure a loan. While your revenue may be increasing, cash flow issues can still arise if income doesn't arrive when you need it. That's where a cash flow statement comes in to help you avoid such problems. What is a cash flow statement? A cash flow statement summarizes the inflow and outflow of cash in your business over a specific period. It's divided into 3 sections. 1. Cash flow from operating activities. This section reflects the money earned and spent in your day-to-day business operations. It adjusts your income statement to show cash reality instead of how expenses are treated for tax purposes. For instance, if you bought a vehicle and depreciated its cost over 5 years for tax purposes, the cash flow statement will reflect the upfront payment you made. 2. Cash flow from investing activities. Here, you'll record cash spent on investments like equipment or infrastructure. For example, if you purchased machinery or sold old equipment, the transactions would appear in this section. 3. Cash flow from financing activities. This includes cash received from loans or spent on repaying them. It also accounts for any money withdrawn by business owners. At the bottom of the cash flow statement, you'll find a summary showing the opening balance, the total change in cash during the period, and the ending balance. This ensures that your cash flow statement aligns with your actual bank account balance. Analyzing a cash flow statement. Let's look at a fictional example of a cash flow statement for the Toronto Raptors, purely hypothetical. For October 2019, their opening cash balance was $1.5 million. By examining the major items we see, most revenue came from ticket sales and a TV contract. However, ticket sales are seasonal, so it's important to plan for the off-season when revenue drops. The biggest expense was player salaries, totaling $10.5 million monthly. Planning when to pay players, especially during the off-season, is critical to avoid cash flow issues. Adjustments like bonuses for winning championships and luxury taxes also influence cash flow. After accounting for these, the Raptors had a net cash inflow of $1.7 million for the month. Planning future cash flow. If you want to plan cash flow for the future, a cash flow forecast is essential. This document helps you predict income and expenses for upcoming months. For instance, you can project when you'll receive payments or need to cover bills, enabling better financial planning. Tips to improve cash flow. 1. Increase revenue. Boost sales by attracting more customers, increasing the average transaction size, or encouraging repeat business. You could also consider raising prices if feasible. 2. Cut costs. Reduce overhead by negotiating better vendor contracts, switching to more affordable materials, or using contractors instead of full-time employees. 3. Speed up payments. Encourage customers to pay faster by offering small discounts for early payments or clearly communicating shorter payment terms. Why accurate bookkeeping is key. To manage cash flow effectively, you need accurate and up-to-date bookkeeping. At All Bookkeeping and Taxes, we understand the challenges of managing your finances while running a business. That's why we offer expert bookkeeping solutions that are reliable, affordable, and tailored to your needs. Let us handle the numbers so you can focus on growing your business with confidence and ease. If you're interested in trying our services, visit All Bookkeeping and Taxes to start your free trial today. Good luck with managing your cash flow and happy bookkeeping.